Everyone saw the move. The breakout was impossible to miss. Numbers climbing, resistance levels snapping, a collective moment where it felt like the math finally made sense. But markets don't exist in public view alone. While the crowd focused on charts, attention shifted elsewhere. Quiet rooms, tight timelines, decisions made without votes, headlines, or explanations. Not to support the move, but to stop it. Because price isn't allowed to go everywhere. And profit isn't allowed to land everywhere. This isn't a story about a rally that worked. It's a story about a system that couldn't allow it to continue. Because the celebration was never meant to last. There's an unspoken rule most people never learn until it's too late. Markets are only called free as long as they behave. As long as prices move within acceptable boundaries. As long as the right people are on the winning side. But when a price starts climbing too fast, too far, in the wrong direction, something changes. The language shifts. Suddenly, it's not about supply and demand anymore. It's about stability, about risk, about protecting the system. That's when the rules begin to soften around the edges. Not loudly, not with a press conference, quietly, carefully, in ways most people won't notice until they're already trapped. And this is where the rules begin to bend. These decisions are never made in daylight. They don't happen on trading floors or in front of cameras. They happen late at night, when markets are thin and attention is low. Emergency calls, urgent emails, closed-door conversations where the tone is no longer confident but desperate. There are no alerts pushed to your phone, no breaking news banners, just a small update, buried in a notice that almost no one reads in real time. A line of text, a rule adjustment, a technical change. But behind that small change is a massive decision. A decision that shifts billions in risk. A decision that picks winners and losers. A decision that turns a working market into a controlled one. It only took one update to flip the game. Then it happens. Screens stop moving. Orders that were supposed to execute just sit there, frozen. Refreshing doesn't help. Clicking doesn't help. The market hasn't crashed, but it's no longer alive either. It's been paused, halted, locked in place. At first, people assume it's a glitch, a delay, something temporary. But minutes pass. Then more. And slowly, the realization spreads. This isn't a technical issue. This is a decision. The system hasn't failed, it has stepped in. And there is no explanation offered, no timeline given, no promise of fairness. You're still inside the market, but you're no longer allowed to move. And once trading stops, panic begins. To understand why this moment matters, you have to understand leverage not in technical terms, but in human terms. Think of it like renting a house instead of buying one. You put down a small amount, and in return, you get access to something much bigger. As long as the deal stays the same, everything works. You benefit from appreciation without owning the full cost up front. That's how leverage works in markets. A deposit gives you control over a larger position. It's efficient, it's powerful, and it's fragile. Because you don't really own the house. You're just allowed to stay there under certain conditions. Now, imagine this. You sign the contract, you move in, the price of the house goes up, and the next morning, the landlord calls and says the rules have changed. You need to come up with twice as much cash today or you're out. Now imagine that happening to thousands of people at the same time. Now imagine the bank calling it risk management. Now imagine the bank changing the deal overnight. That overnight change is where the real damage begins. Because the new requirements don't ask whether traders were wrong. They don't care if the position is profitable. They don't care if the original risk was acceptable when the trade was placed. All that matters is whether you can meet the new terms that didn't exist yesterday. And if you can't, the system decides for you. Positions are closed, not by choice, but by force. Selling becomes mandatory, not because confidence vanished, but because permission did. This isn't people changing their minds. This isn't fear spreading through the market. This is pressure being applied at scale. This is a squeeze created by design. This wasn't a sell-off, it was a squeeze. And then something even stranger happens. Selling still works. You can exit your position, you can give it back, you can hand it over, but when you try to do the opposite, when you try to buy, nothing happens. The button is there, but it might as well be decorative. This is where psychology takes over. When selling is allowed but buying is restricted, the outcome is no longer determined by the market. It's engineered. Fear doesn't need to spread, it's programmed. Prices don't fall because people lost conviction, they fall because the system removed the other side of the trade. This is control dressed up as safety. This is intervention marketed as stability. When buying disappears, only one outcome remains. Step back far enough, and the picture becomes uncomfortable. Because this doesn't look random. It doesn't look like a one-off mistake or an unlucky coincidence. It follows a familiar shape, one that appears whenever institutions find themselves on the wrong side of a trade. Different year, different asset, same response. First comes the run-up, then concern, then temporary measures, then rule changes, always justified, always framed as necessary, always explained as protection for the market, never protection from it. The language evolves, but the tactics stay the same. Each time, the intervention arrives right when price stops behaving, right when confidence shifts away from the institutions and toward the public. And we've seen this movie before. The last time this pattern played out in full view was decades ago, but the mechanics were identical. In 1980, silver was running out of control. Prices were climbing fast, confidence was surging, and large institutions found themselves on the wrong side of the trade. The market wasn't misbehaving, it was doing exactly what supply and demand dictated. So the rules changed. Overnight, new restrictions were introduced. Traders were told they could no longer buy, only sell. Not because the market was broken, but because it was too effective. The result was immediate. What had taken months to build collapsed in weeks. Prices didn't fall naturally. They were pushed. The institutions survived, the participants didn't. At the time, it was called an emergency measure, a one-time intervention, a necessary step to restore order. But what it really proved was something far more important. Markets can be legally shut down when powerful players are cornered. History doesn't repeat, but it keeps rhyming. What makes this moment more dangerous isn't just what's happening, but when it's happening. Back then, demand was mostly speculative. Traders chasing price, momentum feeding momentum. When confidence broke, the air came out of the balloon. But today, the landscape has changed. Demand no longer lives only on screens. It lives in factories, in supply chains, in physical systems that don't care about rule changes or press releases. This isn't just money moving between traders anymore. It's material moving through the real economy. Industries depend on it. Production schedules depend on it. You can't pause that with a trading halt. Which means the system is under pressure from both sides at once. Financial stress on paper, physical stress in reality. And this time, the system has nowhere to run. Look at the number on the screen, and it tells one story. Calm, controlled, contained. Now step outside the screen, and reality tells another. In the real world, availability is tightening. Delivery takes longer. Costs climb quietly. What you're supposed to be able to buy at one price suddenly isn't there at all, or it comes with conditions no chart will ever show you. The number says the market is stable, but reality says it's strained. This is where trust starts to fracture. Because a price only matters if you can actually transact at it. When the digital number drifts away from physical reality, it stops being a signal and starts being a suggestion, a narrative. So why does reality disagree with the screen? And yet, if you go looking for answers, you won't find much. There are no emergency panels, no breathless investigations, no serious questions asked on major networks. Instead, there's noise, distractions, a careful pivot to safer stories. The kind that don't upset advertisers or invite uncomfortable follow-ups. What's missing is often more important than what's said. Because silence, at moments like this, isn't neutral. It's functional. It smooths over disruption. It buys time. It allows rule changes to settle in before the public fully understands what just happened. By the time the story feels old, the damage is already locked in. And nobody seems to be asking why. Follow the consequences carefully, and the picture sharpens. When trading is halted and rules are rewritten, losses don't magically disappear. They don't evaporate into thin air. They move, from one balance sheet to another, from those without power to those with it. The system doesn't stop risk, it redistributes it. Who benefits when selling is forced? Who gains when time is frozen at the worst possible moment for one side of the trade? It's never the small participant. It's never the latecomer. It's the entities that needed the clock to stop, the ones exposed to a price they couldn't survive. For them, a halt isn't a disruption. It's a rescue, because someone always walks away untouched. What most people don't notice is how rarely the system walks anything back. What's introduced as a temporary fix has a habit of sticking around. An emergency measure becomes a precedent. A safeguard becomes a switch that can be flipped again faster, easier, with less explanation next time. Each intervention lowers the bar for the next one. The line moves quietly. What would have been unthinkable a few years ago now sounds reasonable. What once required outrage now requires a footnote. The market adapts, not because it agrees, but because it has no choice. And each adaptation trains participants to accept less transparency, less control, less fairness. This is how escalation works, not all at once, but step by step. And the next step is even worse. If this pressure doesn't work, if confidence doesn't break, if selling doesn't accelerate, the system has other options. None of them are clean. One possibility is forced settlement. Positions closed not at market price, but at a number chosen for convenience. Another is fragmentation, where different markets start telling different stories, and participants are left guessing which one matters. Trust erodes, liquidity dries up. People stop believing the signals altogether. These outcomes don't arrive with explosions, they arrive quietly, with confusion, with legal language, with explanations that come after the fact. And once that line is crossed, there's no clear path back. Markets don't heal on command, they fracture, and none of them end quietly. The real damage isn't measured in prices, it's measured in belief. Markets only function because people trust that the rules will be applied consistently, that contracts mean what they say, that risk is rewarded or punished according to outcomes, not influence. Once that trust starts to erode, everything becomes heavier. Every decision carries doubt. Every number feels provisional. This is called moral hazard. But you don't need the term to feel it. You feel it when risk is protected for some and exposed for others, when losses are socialized and gains are defended. Over time, participation stops being rational. It becomes cautious, then reluctant, then non-existent. Because markets don't run on code or paper, they run on belief. This is the part most people miss. This isn't just about a single trade, or a single asset, or even a single halt. It's about who gets permission to participate on fair terms and who doesn't. It's about which outcomes are allowed to stand, and which ones are quietly erased when they become inconvenient. When rules can be adjusted mid-game, participation stops being a choice and starts being conditional. You're allowed to play as long as you don't win too much. As long as your success doesn't threaten the structure itself. That's not a market. That's a system of control disguised as opportunity. And once people see that clearly, they don't forget it. And that should worry everyone. When rules can change without warning, every participant inherits a risk they never agreed to. Not market risk that's expected, but structural risk. The risk that being right doesn't matter if the system decides it can't afford the outcome. That's the quiet truth behind trading halts and emergency measures. They aren't safeguards for fairness. They're safeguards for continuity. For keeping the machine running, even if it means rewriting the contract in the middle of the sentence. Awareness is the only defense against that kind of risk. Understanding the pattern, recognizing the moment when stability becomes an excuse and protection becomes permission. Because the next halt may not come with a warning. And when it does, it won't ask whether you're ready. The game won't end loudly. It will simply change